with that, we have a fair amount of questions. We had a handful of questions that were sent. Would you like for us to start with those? Um, the ones that you sent over, or do you have a different direction you'd like to go in most
So,
immediately?
so I've organized my questions that I've got into like concepts, like trading concepts, and
Sure.
then jargon. There's like concepts and jargon. So that's how I'm viewing it. But I also don't want to just totally take over everything, even though I came prepared. So
Love it.
like if other folks have things that they want to bring, please do that. Um, maybe maybe I'll just copy paste. I think I'm gonna copy paste all my questions into the chat. How about that
That's great.
as a starting?
I should probably pull up the chat. All right. All right, sweet. Um, why don't we start with jargon, because I think we can quickly motor through that, and then we
Great.
can cover as many concepts as we can. Some of them are pretty simple, it'll be pretty easy. Some of them may take a little more explanation, or you may have some questions. So we'll start with jargon. So the first thing on like trading jargon, the first tag on there, if 513 is traded, does that mean that 513 is hit and then bounced off, or traded through, or it doesn't matter? Can you contextualize that a little bit?
Yeah, so we're in the training room and you're like basically, I mean that was a literal quote from you one like session prep or something, morning prep of like, okay, if 513 is traded, then I don't know what you said after that, but you're like, yeah, we're looking for 513 to be traded. I'm like, okay, then what? Like,
Okay,
what are you
gotcha.
talking about? Is it gonna like bounce from 513 and it's gonna hit it, or does it like go beyond 513 and then we're looking for
Yes.
something else? Like, what are you talking about?
Yes.
I think I remember that day, Baba. That was, you said if 513 is traded, then I'll be bullish or something along those lines.
Right.
Yeah, I got you. So we'll go with this screen. This will help maybe a little bit of that. So there's obviously there's what, 1 2 3 4 5 6 7, it's like 8 lines on here in a span of 300 points roughly. It's like 243, I think, points exactly. So if, for instance, today, um or let's just, I mean, we can pick tonight. So one of the things I said tonight, I think I posted on Twitter as well, that like, and I could have been a little more clarifying on Twitter, but now that we're all here. So when I'm looking at these ranges or these lines, and when I say something like above 285, I want to see 323 traded. That would mean that if I were to garner a position in this area to the long side, I would love to have something left to scale at that target. Um,
So
most of
that's the target. So
most of
like
the
it doesn't
time,
could
it's
go through it or it could bounce off,
yeah.
but it's gonna hit
I'm
it.
so I'm oftentimes, ideally we're trading in the direction that the market is heading in, and so we're going to give ourselves permission to leave money on the table, but at key spots, I want to scale some off because um we never know what will happen. So, for instance, like at a 4 hour swing low, or at overnight low, or at overnight high, any kind of key high, swing high or low, or hourly swing high or low, or a level like something off of this chart, I want to be sure to pay myself something along the way and not just blindly hold on to a trade for forever. So each one of these lines on this chart to me are like rungs on a ladder. And the ladder goes, this section that we're looking at kind of runs the length of these boundaries, and there's just basically just doing some range work and saying like a destination. When we came inside of this area, now you guys you were around the room. Like I wasn't saying, oh, let's all just be short this whole way down. Although there were, my trade today was short. There were other days where we were kind of less activity, not as clean, whatever. But today, like last night and then coming into today, we had sucked back inside of this lower range. So, I don't know where the short was this morning, but we were, I was trading it back down and trying to scale it off, I think, into overnight low. So whenever we're saying traded, it would be like 513 would be a key spot. Like if we get to 513, this is the way I was talking to Banks about it the other day. Like if we get to 513 and buyers decide to just mail it home, like we're trying to get up to 513, let's say we're climbing the bid or climbing the offer. When we get to 513, that's the place I'm going to take some off, but it's also a place that the bulls really they don't need to quit there. That needs to be the floor for the next leg up. That's the way I would look at that a lot of times. So it doesn't
So,
necessarily mean I'll fade it there and flip short, but I'm going to be cautious.
great. So we don't know what happens next, but we want 513 in this example to get hit.
Yep. Yeah,
Great.
and the thing is too, with trading on like the side of trend versus a backside trade, you're almost always going to leave something on the table because you're going to scale. You're going to need to be scaling one of two ways. Either you're scaling into swing highs, and you're getting taken out as the market goes in the direction you intend, or so in that scenario we move higher than where your last scale is, or you're trailing your stop on a 30-minute swing low or 5-minute swing lows, and so a sharp pullback will take you out and then the market may continue. Either of those scenarios are fine, but we don't want to be all consumed with capturing the entirety of every single move. We want to kind of give ourselves permission to kind of be, quote unquote, good enough.
Great. Thank you. Okay.
Yeah. Buys and sells passive. That was another question you had?
Yep.
All right. That will be able to answer with this chart. So if you or anyone has not ever seen a footprint chart, this is a bid ask footprint chart. So I'm going to make it as pretty big. So what this is showing us is showing us the activity on the bid and the offer, and it's showing us the delta that is built, which I think delta is another question on here somewhere. So we're going to loop that one in as well. Where is delta? Negative delta, positive delta. Yeah. So delta is the difference in the bid and the ask, the difference in market executed orders at bid or at the offer. So meaning when you click market buy, you're actually buying from the offer. And that order that you buy was passive. So you reached up and took an order from the offer. So you are the aggressor. When you hit market buy, you're the aggressive buyer. If you set a limit order on the bid, right, and you're just sitting there waiting, then you're passively waiting to be filled. So that's bids and offers. Amazing. Passive versus kind of aggressive. Or seemingly aggressive. And yeah, like Kyle said, every market order is paired with a limit order. So when I say there's passive buyers or passive sellers, I'm referring to the amount of orders that are on the offer that are being purchased by market buyers. And so if someone continues to refresh, meaning we buy up a little bit and then they put more orders on the limit side of the offer, and then they get bought again and they stack it, that's where you see these like lines sticking out a little further. I mean, generally speaking, we don't know. I wasn't watching these happen, but so someone here had, was sitting there absorbing those 50 orders that came through. So buyers are, aggressive, sellers are passive. Here's a good example. This big blue circle means that there was a sizable market buy that went through here. And so that's another thing you'll see on this chart, as well as on this chart. When you see these numbers pop up on here, if the circle behind them is orange, then it's a market sell. So that's a limit. Yeah. That's a passive buyer, and that's an aggressive seller. And then if you see it has a blue circle, which you can't see it super well because I don't want it to like clog up my chart a ton. But if it has a blue circle behind it, then that's a market buyer. But that's also there's a passive seller that at that price was willing to sit on the offer and with 20 lots and let that be bought up by Mr. Buyer. Right. And these, when they pop a number like this, that's a single order. So that's one click and someone took 20 in one order. Where we're trading 2s, 3s, and 6s, someone just threw 20 down. So
and these are 20 of like NQs, not MNQs,
yes,
right?
This is 20 of NQs. Yep. So that's the difference in passive and buys and sells being passive versus aggressive. It's whether the order was executed at market or whether the order was executed on the limit side. And the funny thing is, every order that happens is simultaneously someone's limit order is someone's market order, right? Because for every buyer there's a seller, but we're interested in oftentimes looking at who's continually crossing that bid or that ask, who's continually, are we getting a bunch of big market buys, boom, 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 as we trail higher in a move, or are we getting a bunch of market sells as we trail lower, and vice versa? So we're looking to see who the aggressor is, and we see them create that. Yeah, exactly. Yep. If there were all limit orders, we would never be paired because someone has to initiate. And then delta is built, delta being just the exposure that someone has, meaning this 20 lot buyer, let's just pretend that wasn't them closing a short. Let's say they were buying a long right here, then they made 20 positive delta, most likely, in this buy. Meaning when the market moves 1 point, it will be as if it moved 20 points for them because they have 20 contracts on, in theory. So the other thing about that is when you see the delta in this candle, this little graph at the bottom down here tells you how much, whether the sellers were super aggressive or the buyers were super aggressive into an area. And so you can kind of begin to learn some of the nuance of how much delta in a given 512 trades, how much delta is normal to see one way or the other, and when is someone like getting out over, you've heard us probably say getting out over their skis at some point. And that's kind of the same thing. Like when you come into a swing low, and you're building 130 delta, 85 delta, 57 delta, those are aggressive sellers and there's buyers that are on the bid side kind of absorbing some of that, and so it can create inflection points at times. I don't exclusively execute or trade off of this information, but I do use it just to contextualize what's happening. It keeps me aware. Amazing. Like down here, big market buy, and this is into the low a day, or actually after the market was already closed. But big market buys. And another thing that you'll see, and this is just, something to note, is if we have like, let's say we're coming into an area of interest, that's when I may look at this chart. So let's say that 252 was an area of interest, and we saw this big 76. We built a fair amount of negative delta as we pushed down, and then there met, like, we have kind of a pause candle, and then 130 positive delta was built in this little stretch, which to me shows that not only are these buyers well timed because they're executing around a level that I think is important, but also there was a lot of them, and the sellers kind of actually tried to hold it, and we expressed higher. So that was a tug of war there, and the buyers won. When you see big discrepancies in delta, different things like that. So that was a two
So,
for
like
one.
in this example, amazing. So, positive delta would be like there's passive sellers and big aggressive buyers,
Mm-hmm.
and they're just blowing through the cells
Mm-hmm.
and probably creating like a fair value gap potentially, right?
Potentially, yeah. And what's really fun to do is to go back and look at, say you have a fair value gap that you were watching and we traded into it and it was very responsive. Going back and looking at when that fair value gap was created, what was the makeup of not only the volume that was or wasn't present, but you can also look back at the delta that was or wasn't present and get some just some insight from that. One thing I'd like to point out that you have to be careful with, if someone's watching this in the future or watching it now and thinking, oh, delta, the savior of the world. So oftentimes when we're entering into swing lows, or for this example, and you see a lot of negative delta, what you want to be careful to not just immediately think, oh, I'm going to fade those sellers, because yes, there was a lot of negative delta put in this candle, almost 100 negative delta. That doesn't mean that they were wrong or that this is a bad trading spot. If we were to then follow that 98 negative delta up by 120 and then 130 and then 150, we would be 30 or 40 points lower than this. So just because we see a lot of delta isn't automatically assigned to fade it. Now, this is a cool setup because we had aggressive delta in and then immediately a bunch of positive delta that ended up, squirting us higher. And then they followed that up, kind of a working bar, a little bit of a rest, a working bar, another working bar, meaning building, around 100 positive delta as they pushed it. But you can find plenty of examples where delta back to back means nothing. Like right here, weak sales, negative 19 delta, negative 3, and then you have positive 173 delta, and we roll over. Like, these guys couldn't get anything going here. So it's not magic, but it's definitely it can contextualize things.
Great. Can you tell me, so it's pouring where I am. Can you tell me,
Yeah.
can you hear that? Is it messing
No,
with
it's not.
the
It's fine. I don't
video?
think even if we could hear it, it's okay. But I can't
Okay.
hear it.
Be a nice pitter patter of the rain.
Yeah.
I want to give other people opportunities to ask something too. If anybody wants something, maybe we just leave like a few moments of space and see if
Yeah.
anybody else wants to chime in with anything.
Yeah, for sure. Any questions, comments? If you have a question, you don't want to say it out loud, type it in the chat. We'll wait here just a second. Oh, good question. The volume of this was actually, this is actually 512 trades. So each one of those candles was 512 trades. So 512 trade. If I were going to look at a volume candle, I'd look at 750 volume. If you like volume candles, I wrote that in the chat for you. For NQ, specifically for NQ. Yeah.
Might want to explain the difference of that real quick, just in case anybody doesn't know.
512 trades would be exactly 512 trades. 750 vol. I'm not explaining it well at all. So I'm about to say 750 volume is when 750 a trade and volume aren't the same thing. A trade executed.
Not just for you, yeah.
Do what?
So it's not just for you, ERTX.
Yeah. So every trade builds a different amount of volume.
Yeah, it could be a 5 lot, it could be a 10 lot.
So one trade could be 15 volume, or one trade could be 1 volume, depending on the size of the trade. So you're either looking at trades or you're looking at volume. Is that a good way of saying it? It's kind of, I mean, that's the way that I think of it and the way that I process it.
Yeah, I think so.
Yeah. So when you're looking at 512 trades, you're just saying, not necessarily with concern to how big the trades were, but or not with not necessarily concerned with the volume created per se, but to categorize in a given amount of, you're chopping the trades that come through up into equa-sized chunks, I guess is a way to say it. 750 volume is a great way to see rotations, in my opinion, small rotations and stuff. So smaller rotations, average rotations. 512 is feels a little more granular. So
what's next on the list?
All right, let's keep this party going. Is single print synonymous with fair value gap? Great question. So yes, and I would say, meaning if you are on a TPO chart and you have single prints, let's find some here, right, where we traded only one. This is hard to see without blowing these out, but each. Let's do it this way. Let's just do it. Letters, blacks on column. So each one of these lines is 30 minutes. Okay, 30 minutes of trading. So when I blow this thing apart like that, you can see 30 minutes down, 30 minutes down, a little bit of balance, and then this break. Well, this break right here, this is a 30-minute fair value gap, right? Because from the close of this candle to the open of this candle, there's nothing overlapping here, right? So it's a space. That is the width of the fair value gap from the wick of this candle to the wick of this one. However, when you collapse it, you get the single print, which takes into account everything that happened leading up and after, and it's going to be a much smaller. It's going to be typically a much smaller range. So
wait, what do you mean you just collapsed it? What just happened?
Yeah.
Can you go back?
So this is a TPO chart, which means it's a time-based chart, but instead of viewing the candles all stretched out along the day, width-wise, we're taking them and smushing them all together and pretending like they just happened one right after the other, and we're looking at the excursion and the time spent. Now, that is what gives it this look, but then also I can blow it apart, and then it looks a little more like a normal chart if I really make it big. So this would be 30-minute chart for the day. If you put a 30-minute chart up, it would look very similar.
Got it. Okay, thank you.
And so a 30-minute fair value gap would be the low of this block to the high of this block, because there's this gap in activity with nothing overlapping. So a fair value gap is going to typically be a wider range. Single prints are going to be the dead nut, like the middle of a fair value gap, which typically a fair value gap, the midpoint is where you want to execute if you're trading that style. So if we blast this back together, you can see that the single prints is only a 7 point, 8 point range, And if we blow these apart, it's like a 40-point range. So this is the fair value gap, and this is the single print. So it's just a more detailed way of looking at it. Now this is on a 30-minute time frame. You could take it to a 5-minute. It's going to be the same general idea. So they're similar in nature, how they're created, and they're similar in location. There's always going to be a single print where there's not always going to be a single print where there's a fair value gap. Single prints are a little more structural in nature, and it takes a little more to make one during a day. For instance, there's probably a fair value gap somewhere in one of these insets, but there's not going to be single prints there. Yeah, so there's a
Do
fair
you
there.
value single prints more in your general trading strategy than
I
fair value gap?
I look at single prints. They're almost always synonymous with low volume areas. You're not going to have a single print without a low volume area. So I think of single prints. I don't really talk about them much. I notice them, and they're kind of probably rolling around in the back of my mind, but I'm not really valuing either too much over the other. I like to consider them both. I would say single prints on a TPO chart matter more to me than a fair value gap. But just because of what it takes to create single prints would be much less trading through an area than a fair value gap. Again, because like here we have no single prints, but we do have a fair value gap that formed there. And if I do it, I could do it on like an hourly chart. So this right here probably wouldn't be single prints, but it is a fair value gap. I guess
Cool.
most immediately it would have been, but it quickly filled in the single prints and the fair value gap. So, but yeah, belabored the point a little bit, but I think you get the idea. Single prints just means that we only traded like, if you were drawing, for instance, this, let's do it this way. So this is the fair value gap, right? Boom, boom. But the single print for this area would only be that big. Because all of this would get collapsed together if it were a TPO. So you really only get like true single prints on a TPO chart on this chart. Like you can only really see them well on this chart, but they both I'll tell you this, they both point you into the same idea that there was an initiative move out of an area. A single print is just another way to quantify initiation, like strong buying, and they're meant to be filled, right, Banks?
Yep. And then, hey, while you're on this chart, because I don't deal with TPO that much, but can you talk? Because I know you said it in the chat, and I know it's going to be a question eventually, but could you talk about cleaning up a high or a low?
Yeah,
in
for sure.
TPO?
Yes. When I say clean up a high or a low, this is a great example. That's just a terrible high. There's no excess. So if we finish a day like this instead of like this, so you see how we have this. Let's grab the epic pin here. I think this was another question that might have been on the list too. So this falls right in line with what we need to cover, anyways. So you see how we have kind of this.
I think you're behind your picture.
Oh, I am.
Just scoot it over. Yeah,
Hold
scoot
on.
that over a little bit.
Look at this guy. What is he doing? Get out of here. There. I can see it on this other monitor. I just wasn't even looking at it. Sorry. Okay.
All good.
So you see how there's a tail here? There's there's only one set of blocks in this area. So this high has decent taper as well on the volume. So for me, when I see, a nice tapered volume, and we have, let's make it a little bigger so y'all can see it. And we have this taper on the volume, and we have a nice tail. This is a high that is fine. Like, there's no need to go back up here and deal with this. So for all intensive purposes, this could be enough of a high to be the high. When I see a low like this or a high like this, that is it's kind of poor in the way that it's made. Um, it's poor because of the way that it was created, contextualized. I mean, so let me do this. So if this looked more like that, that would be cool. That would be workable. And you see how we came down here and cleaned that up, and we fixed this dumb situation. So what you'll see a lot of times is yes, there you go, stops. Well, a lot of times we'll get stops that are being trailed up through here, and it's not that we have to go immediately and get that. That can be the lure sometimes, like, oh man, I'm gonna keep shorting this thing all the way up because we got to go clean those stops up. And we may very well do that, but it could be in the next session, before we do that. And so, but once we have a nice look on the high up there, we're looking to kind of get that taken care of, which we get that taken care of here. So that's also something you'll hear me say, and I have to be careful of this because I don't really like. I just don't like leaving this kind of thing behind. But this is a mechanical low as well, so I think that might be on the list somewhere. But I'll reference a mechanical high or a mechanical low, and what I'm talking about is like one that's almost manufactured, and this like stark angle like that on the low is very much what I would consider mechanical. Will I show it on a candlestick chart? Yes, I will. So what day is that? Monday. Yeah, Monday we'll do Monday the 22nd. So we'll do a 4-hour chart. You look at it. So it would have been RTH. So it would have been this business right here. All this business here would be what you were. Let's make them side by side. Hold on. So that's RTH only. So it's this kind of low. And the thing is, like, that can work, right? We were long. Were we long? We were digging for longs in here, or were we short? I can't remember. Oh no, I was shorting this down every time. Yeah, Monday. It was like short scale, short scale, short scale, short scale, and then I got tired of taking 12 or 14 point profit, so we just closed it up. But that's the idea, is it'll look like that. This very silly looking mechanical, but we can use that, and the market often does, and that's why it's careful to fade it. But we can use this to engineer for the cleanup later, knowing that we have just a million stops there. So you'll
Got it.
also
So like it's likely to go back there where there's
it's
liquidity
that
traps
yeah, that's a great target to have in the back of your mind. If you get positioned for a great short and you feel like you can manage risk on it, it's a great place to look to get back to. But again, for that move, we didn't get back there till the next day, or Globex that night. I'd have to look at more to see. The other thing you'll notice that kind of thing show up, like when you're coming like this, like we're coming back into a pretty clean area of volume like this. where a lot of traders, myself included, and you sometimes can get away with it, you're looking to press past the top edge of this volume to rotate down this volume node right here. And so a lot of times we do get that mechanical low in a pretty obvious, what I would consider a market generated level. And it's just that we're gonna just screw around for a little while and then eventually come back and get it. Most often we do. But a lot of stops build up there. And yeah, it can be a great, target to trade through or to clean up. So that would be it when I reference cleaning up a poor low or something like that. That's what I'm talking about. And then there's weak references, which are more where the reference is. Like this 409.50 is a weak reference because it was just a low of balance. And so it's a market generated level that's just super obvious. So when we come back to it eventually, I wouldn't anticipate it to hold, but then like getting back above it would be pretty key. Another example of that. Yeah, I can look around. But so yeah, any other thoughts or questions about the TPO chart before we, or does anybody else have any thoughts? All right, let's go to so yeah, cleaning up a spot, that's partly what I'm talking about a lot of times is that. If we're looking to clean up a spot, it can also be like a skipped auction, which I think is skipped auction. So skipped auction is something to be careful of on an open, okay? On a Sunday night open or any Globex open. We can skip some auction and leave that alone for way longer than you think. Right, Banks?
Like a day.
Yeah. So just because you see skipped auction does not mean you got to go get it. It can be great bait.
Yep.
We learned that lesson the hard way.
If it happens within the trading, like after, like the gap, basically, like once that happens, like you'll see in Globex a lot where we'll have skipped auction. Like if you're looking at the 1 minute or 30-second chart or whatever, it'll actually skip price.
Yeah, I'm gonna.
That can be great.
Show you.
Like, yeah, I would show that because that's a great price. Like if you get a decent move away from it, that's a great target because it usually will go fill that relatively quick.
Let's find a good example. There's one.
Yep.
So you see how we just had nothing here?
It's just a pure skipping price.
Yeah, and here. So a lot of times, if we're incredibly bullish, there's been a couple times we've all traded together, and today would not be a great example of that because of the aggressive move down. Though we could probably find some skipped auction from on the way down and talk about it, but it's not really worth finding. It's just when we skip price, basically. They're so excited to sell and the bid's just not there. So it's a lifted, it's a bid that's just pulled basically, and we have these blank spots in there. And so a lot of times if I'm trading in a general direction and I see some skipped auction, so let's say I was short here and we got this great move down, I'd be really nervous if my entry was lower on this short than the skipped auctions, because I would fully believe that we roll back up and clean that up before another leg lower. So if I'm long and we get a skipped auction, I'm just going to allow for it to pull back and clean it up and not be too concerned. And there was a day a couple weeks ago where we did that like multiple times. I was like, oh, if we tick back down to 53 and clean that up, it's not a problem. Or I'd like to see that happen before we go too much further. And you're thinking, well, you're bullish and you want price to go higher. And it's like, yeah, but I want them to go ahead and clean that up so it's off my mind. And so there's no need to go back and repair. So cleaning up the auction can be that, or cleaning up the auction can be with like a regard to volume profile or TPO, like we were just talking about a moment ago. It can be either one of those things, and both, I think both are important. But I would say one to the point of like on Sunday nights, a lot of times when we open, you'll see us skip around as price goes, and yeah, it can be bait for sure, especially on a Sunday night open. And one of the things that we learned the hard way, years ago, was when we would see that, we would think, "Oh, I'm fading this move back into that skipped auction." Dude, they will. I mean, the market will go 100 points, can go 100 points, and wait a day before it goes to clean it up, or two on a Sunday night. So don't think that just because we have a skipped auction, we have to go back and get it. Intraday, it's a little more consistent to go clean it up, but on a Sunday night like that, yeah, and there it is. There it is on. People would also call that on a time-based chart volume imbalance. So there was no volume there, right? So it's just an imbalance of the volume. Why does it need to get repaired? It's not efficient. I mean, if you think of delivering and advertising, if you think
Just
of
wondering if it means like, say you got like a market maker or some large institution that's trying to fill a position and they slap a big order on, skips auction, moves away from them. They probably still have more to fill. So maybe until they get their fill, they're not willing to put more on.
yeah, maybe, but dude, on Sunday nights when it when it goes
Oh, well.
it go 150 points or like 2 days. I mean, there was a week where we made it to like Wednesday before we went and cleaned that stuff up. Banks and I were just shorting every rip. Didn't get paid till Wednesday. So yeah, I don't know the mechanics
That
of.
wasn't recently, by the way.
No, yeah, that wasn't
FYI.
recently. You guys have all traded with me recently. I haven't shorted every rip in a while. But yeah, it was boy, it was something. So we made like a pact that day, in the same way that we don't trade the Russell. We don't fade poor market structure on a Sunday night. So, because you can lose your shirt doing that. So yeah, I don't know the details around it. I mean, I think of it like advertising and efficiency. So the market is trying to efficiently advertise and deliver, opportunities at all these prices to discover where participants, whether algorithmic participants or handmade button clickers like us, or large institutions, are interested in engaging with price, and finding fair exchange. And when we have a price that was totally skipped, it just seems like they didn't do their job, at least delivering and giving price an opportunity. So that could be part of it. So yeah, that's the cleanup. Swept the low. Banks, want to talk about sweeping a low?
Yeah, so
I'll pull a chart up for
in the
you.
matter of like in the matter of like liquidity, in the sense that the way that I look at where we target is, liquidity to liquidity. So we like to go from buy side to sell side to buy side, and in theory. Now it depends on if if we go like an internal, like in a leg, you would call that like an inside, or I would say that's a weaker sweep of liquidity. It's just inside the move. Internal, you could call it. External would be like from leg start to top of, like if we're going right there, from that low to high, basically losing that low would be like the external,
I'm coming.
sweep of that. So, in the sense of like sweeping liquidity, like if like going back to that TPO where we kind of set up that day on Monday, Tuesday we came back and we basically swept through that low, cleared out those stops. I think it was at first the box to the left. Is that the same day, or is
Yep.
that?
No, that's
Yeah. So
that's a Monday, and then Tuesday we swept that low.
yeah.
Cleaned up this auction.
So yeah. Yeah. And that's exactly what we mean by sweep is in an area of interest of where we want to be potentially targeting. that low is kind of manufactured like he was talking about. So the goal of the sellers is to target that, and to get below that would be to sweep through and go target the other side of that volume, which you talked about earlier. Now, peaking below that and getting back inside of that area, to me, all that is just stop taking. So that would be sweeping the low and getting back inside of where price came from.
Yeah, and you say that often when we're trading, like we could sweep, like you'll say we can't lose this low. And there's a difference in losing a low and sweeping a low.
Yeah.
And so a sweeping is like a liquidity grab, and we're right back where we were. They're annoying, and they can take a stop. They can take your stop if you're, because you can't just allow price to endlessly move against you, and you have to pay attention to pace. And a sweep can look aggressive, but if it snaps right back, it's not a big deal. A lot of times it'll be at these hard edges of the market too that banks will say like, well, like for this day, we don't need to sweep below this low. We need to trade below this low and establish that low as the next springboard lower. So
Yep.
you'll see that a
I
lot.
mean, look at Globex tonight.
Yeah, you'll see
That's a
that
perfect
here.
example.
This is a perfect example. So in this leg right here, which, yeah, I mean, really
So
good
and
example.
if you look at that on the 1 minute, if you look at that on the 1 minute, that move from 325 down to 288, that whole leg from 9:30, well, I guess 1930 Central, to the high, everything in that leg is tested. So losing that last little swing at like 17,315 roughly at about, what was it at? So it'd be 21:55 your time roughly.
Yeah, all this
So
was
like that
tested.
low that gets put in, all that move was tested on the 1 minute. So losing that swing low to the right of that opens up that kind of floodgate move down, which is what you see.
So what do you what you I'm going to draw this and you can talk about it cuz um this goes into just pullback, back test, blah blah blah. That whole question. This kind of is where we probably could spend a fair amount of time. And I'm good to go. I need to get to the other screen though. Here we go. So so you're saying like, okay, we come off these lows, boom. Here we break the high that brought us down there. So now this low is pretty important. So we pull back, we
Come down,
rebid,
test it.
we rebid out of, this area. And I'm going to go ahead and stop right there. I cannot do this and have to go back and erase it all. So I'm going to do it with the Epic Pen. That's the whole reason I use that thing. So, yes, if OMC swept the high, and if I would have not given up on trading it, oh, that would have been such a good selling point. Oh my gosh. Okay, so you got this move down. Okay, we get this move above this high, so then this area needs to defend. So the only thing we could do, like with regard to what we're talking about, is rebid it, which we did, or we could have wicked down and immediately recovered. But what we couldn't do is trade down and use it as a springboard to push price lower. So we rebid it, we moved up, we made a little bit of a new high, we rebid this little spot, we moved up, we rebid, we moved up, then we rebid basically these highs, then we moved up. Like I said, it's a little bitty failed auction here. Rebid, moved up. This is where things got slippery, traded below all this, and now this move, and let me clear all this real quick. This was your move that brought you to the high, and we lost it. Not only did we lose it, we lost this, and we lost this. We traded to this. So
traded to it.
So then when we go marching back up, the only option for buyers, and this is where we get into these moments where, like today, this morning, when I was like, if buyers got to go, if they don't, so I got long, immediately flip short as soon as they faltered, because here, like, this move has to go, and when we say go, it has to trade through this high for this trend to continue, because now we're vulnerable. Why? Because we back tested these gained highs here, we back tested this failed auction here. We've back tested this failed auction here. The only prayer you had was here, and they motored right through that. All of this is already
See,
tested.
but even on that line that you drew, the way that I look at that is basically the wick. So I'll look at
Yeah.
wick high to wick low,
Yeah.
and to the right of that is where we tested that move.
Yeah.
So we dropped through that, but we tested it. Even that line, we pretty much tested on that X to
Yeah.
the middle of the
Yeah,
screen.
the wick high here,
So-
it tested here. But the point is,
Yeah, so in
this
essence,
can't be
losing
lost.
that, yeah.
Like, you can't trade back to this and expect it to hold. Now, here's the thing. Anything can happen. Anything can happen. But what's most often true is that if we bid up in this fashion, it has to continue, or we have to make an expanded move to buy some room and get like a nice fair value gap, single prints, or something to give the buyers a chance to take a rest and then continue higher. What we can't do is rebid, and then pull all the way down and expect that these rebids are just going to hold because they held last time. If it's already tested and rebid, then it's not A plus to bid back into. So this move here, when we broke this and we broke this, I mean, this was all kind of, whatever. Maybe that was the first test, but this push back up, you see I mean, and that's the thing, like, put pressure on the side you want to trade with. I think that's like, so what I mean is, like, what do you want to see out of this bid? You don't just want to see move up to 22 from 16. A 6 or 7 point move. The goal of anyone that bought in here is a new high. I mean, it has to be. What else is the point of buying it?
Yeah, and then the thing on these these sellers too on the backside of this is they basically allowed themselves to give a breathing room up to basically right here.
Yeah, now this is
getting back above.
Yeah,
getting back above like 316 roughly, or 315 or whatever. That's when you start opening up these
that's the
little
key
floodgates
spot.
back up to that high.
And why is this spot so key? Because we basically just chopped our way down, reoffered here, chopped our way down, reoffered here. So if this doesn't hold, and it might hold the first time, but now we have something, in my opinion, you have something to work with in this area that you could actually pull back to, and then the goal is this high. So a decent-ish, not 100% because this is a 30-second chart, but a decent-ish trade with good risk would be a long from somewhere around here, the stop just below. If they give it to you, if they're kind enough, especially if they go ahead and test this area, and then you're targeting, maybe this swing high, but in reality, it's a failure unless we clear 32. And then you can quantify it with time. Like, how much time do you want to give that trade? And then price also defines it as well. How much price, how much of an excursion are you willing to take? But that's on a 30-second. If we jump out, and this is the thing that's, while we're on the subject, if you pull out to a 1 hour chart, that looks real trappy. Like, that looks tough. Because basically we pushed all the way down here, swept this low, but that was where that actually on the hourly is where the sellers needed to kind of shore this thing up for the most immediate strength to the downside and start to journey their way back to here. And don't get it twisted, this is the goal for sellers tonight, or for the immediate future. Now they have two goals. Goal number one is getting back below 88, and goal number two, taking into account volume profile, not structure of candles, is to get back through this 68 to 7. This is a pretty important spot for me. But ultimately they're trying to go take this low. Ultimately, the goal of this potential auction down is to take this. So it's a piss poor attempt if they fail 20 points into it and get bought all the way back up. Now the onus is on the bulls, like we talked about, to continue, but they do have a little bit of room on a small time frame. They got a little bit of room to pull back to, somewhere in here, maybe somewhere in here. Trappy, that's another one. It looks trappy because on the small time frame it looks super aggressive and like, oh my god, this is going to zero. But that's trappy to small time frame traders. When you go out to a bigger time frame, it was basically they sold it off to the point where it mattered, and then they kind of gave it all back up. Now that doesn't mean that it's definitely going to zero, but if I were short, I would really be concerned to get traction pretty quickly back inside of 300, back inside this 302, 303 spot. And I'd go ahead and cut this trade anywhere back up into this, because there's probably a lot of trailed stops in this move, and it's vulnerable to just spring through. So
Okay, but I'm still not totally clear on what trapped means or trappy.
okay, trappy would be on right down here where this low is, was really where, like, all of this was, I mean, it mattered, but it really, we couldn't, at this point in the journey, we couldn't even close below this. So this wick down below this low probably enticed people who are breakdown traders to go short, believe it or not, for a trade
And then
lower.
immediately take a stop.
And immediately take a stop. So anybody that sold in this candle was basically trapped. I mean, this isn't a prime place to pile into a short. Your short trade should have came in from this region, risking off of something up here, and you should have been scaling. You should have been buying back the short in this area, at least part of it. And so it's trappy because on the hourly, we did take a couple of swing lows, but anyone who was initiating like a breakdown trade got totally ran over. So trappy just meaning the location of the trade entries down here was not ideal.
Amazing.
And it
love
looks
it when it's
yeah,
there. It's so good.
and it looks good on the 1 minute, like, oh, what a powerful move, or the 30-second. But if you go up a time frame or two, you realize like, really, they just ran it to the edge of glory and then just gave up. Like they just kind of crapped the bed down there where it mattered. And yeah, so that's what we mean by trappy, and that's some of the context around sweeping a low versus like this low. Wrong tool. Like this low wasn't a sweep. This low we traded below, spent a couple minutes below it, pushed back up, and then continued down. And yes, we wiggled above it, but contrast that against what we did at this low. That was a sweep. Grabbed the liquidity and we ran. Now we ran right up to where I would say, like, but we'd probably want to see this get traded through up here if we were long right now. So the fact that they got all the way back up here and kind of ran out of steam, not the best look, but to see continuation or to see some type of activity that looks like, this would be okay. I think this is kind of the key spot for this move. Also, all these people that sold here, they will probably buy it back if we get back here, because there's a lot of sellers that put it on the line there. So as we press back into that, that would be negative delta. So it'd be market sellers. So all these people jumped in, da 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 da, and then who didn't get stopped out there? Who's praying to God we make a pullback? Most likely would want to buy it back there. I would. I would have already been stopped out, but I also wouldn't have taken that. I also wouldn't have taken that trade either. So, way down there. So at least I'd like to think that I wouldn't. All right, sweet. I'd like to close above 90, then back test 80. This is the spot to pull back to. Think of back testing differently. Yes. So, not speaking of back testing in the researching a trading concept or strategy. I think we mentioned back testing a level in this would be like if we were so here's a great example. Well, I can't draw a line that far straight, so I'm going to have to use the tools on the chart. So this is to the point of what do we mean when we say I'd like to close above 90 then back test? Would mean that this move right here that also looked a little trappy because we just wicked below and came right back. So that's a sweep. We swept this low. When we swept this low, Banks would probably say, I would probably be saying, oh, we can bid right here and have our stop at the low. And Banks would say something like, I'd like to see us trade above 303. I'd like to see us close above 303.75. And then I'd like to see us back test. He would probably say, I'd like to see us back test probably right in there, somewhere in here. 298. Now this is Globex, so the ranges are really tight, but that's the idea that you get a move above the local high. And this is a 30-second chart. We don't usually look for structure on that small of a time frame. The high that brought you most immediately to the low, Banks would be looking for us to trade above that, close above that on whatever time frame, which we get 3 closes above, and then wherever there was a small pullback in that move, which would be anywhere in this region, he would want to see us pull back there, bid, and then his next target would be back up to that high that brought you to here. So he would have a trade from 298 to like 310, but his risk would only be to like 94. So he'd have 4-point risk for, 14, 15-point move, and he would scale 1 here, and then his stop would go to break even stop, and then his next target would be these highs. And he would be looking to scale once we got back up there, he would scale 1 into that swing high, and then he would go stop to break even, and then he would look for a move through the next set of swing highs, which would be here, and he'd scale another one here, and then he'd probably bring his stop up to like here. And then he'd probably be looking to either scale here, or if there's some other structure up there, you're looking to scale another one, or he would bring his stop to here. And then he would have probably just taken the trade off somewhere in here, or he would have got stopped before this big move down. But that's the anatomy of a Banks trade right there. What do you say, Banks?
100%.
That's the high, brings you to a low. Let's say we had a key level in this area, an area of interest. You want to, ideally, we just trade and don't go below it. But if we do, you got a high that brings you down there. You're looking to see a close above. We get that here. Once we get that close above, we're confirmed that we've gained something on this, at least something. And then we look for the flag that brought us there. And that flag is here. So this is all entry potential. Enter here, stop below this swing, because if we trade below that, we expect this to continue. We get this bid, target 1, target 2. Well, you could maybe take that, but I think he would probably be going for this. Target 2, and then stop comes to here and see what you get, and then you get stopped out. No big deal. You see that over and over again. He's really good about just taking 20, 30 points with 3 or 4 contracts, and you do that 2 or 3 times in a day, and you've made a decent day. Here's this failing to pull back. Now we traded, and this is another Banks trade. Probably wouldn't like this one as much, but now we traded above the high that brought us to this low. We did that here. So now you got a little flag here, a little flag here, and really wouldn't want to see this deep of a pullback. So you could have an entry here or an entry here, risking off this low or this low. And then your first target, if you entered here, would be whatever high brought you there. That'd be target 1, target 2, new highs, and then scale the trade up.
All right, amazing. So the back tested area on the previous one would be what, like 98.25?
Let me get over there.
Was that the Yeah, that
Yep,
was
yep,
that
yep.
was the back.
Yeah, and basically what
It
we're
would also
saying,
be the entry probably
it
in
would
his-
be, this would be what you'd want to see back tested. This little flag. If you imagine this is the pole, and this is the flag waving in the wind, you want to see that flag tested. That's Kyle's language. So pretty
And
great.
I would on those flags, the way that I would measure them is, so if I go high to low on that, I usually want to see it bid within the first 50%. Usually, if the 50% mark gets traded through, usually that low is getting taken.
So he's looking to execute in this region, and so was some other people. And this would have probably made you frustrated, but you still would have been alive in the trade. So I mean, what I mean frustrated is just, you would have liked to seen a little more aggressive move. You want to see a close above. So this was kind of a stick save right here, meaning they about let it slip out of their hands, but they, as a hockey term, they stick saved it, right? They barely caught it at the last second, and you get that move up. And that's just like price action trading. Okay, that is, you can trade that anywhere on the chart. It's probably going to be much better traded around an area of interest. NQ special is this is an NQ special in a small way. NQ special is just the fact that the NQ is such a it's just, it can be the funnest thing to trade, or it can be just a hoe bag. So let's say that you were lucky enough to short this right here. Oh, not lucky, but let's just say you were like, oh man, this is a great area I'm going to short. And you shorted the top tick. You shorted 14.25. Or actually, no, let's say it's a better NQ specialist, this one. Let's say you saw that and you're like, oh, as long as we don't trade above that, I'm going to short it. So you shorted 12. This move right here is the NQ special. They go ahead and take your stop at 12.25. Like one tick above that and press down. This is another NQ special. You trade up, you pull back, and then you don't take the high. Lord no, you just trade 75 cents from it and then give this whole move up. So everybody that tried to short right here off of this, they get stopped out. This is about an NQ special here as well. This high it becomes really important on this move back up, and you just barely trade above it and pull back. It's like, oh Lord, what are we going to do? So an NQ special is just whenever we, on a small time frame, just go right to the edge of a local swing high or swing low and go 1 or 2 ticks above or below it. Like today, my stop on that short, y'all remember that, right? Those of you that were around, I was short, and we traded down. We went 2 ticks from my exit, came all the way back to 2 ticks from my stop, and then we got the move through to a TP to a new low. So that was an NQ special both ways. We went right to the edge both times and then went. And you'd be surprised at how many times that type of thing happens. Those of you that've been around a while wouldn't be so surprised because that's what the NQ does, right? This is sort of an NQ special here.
And this isn't anything defined. I think it's
No,
just something
it's
that
just
we
something that
use
we
to basically
say.
say
We
that NQ's kind of a B
Yeah,
sometimes.
she can be a B. Like she gonna get 2 points from this swing low, which is good to see if you're long. But where do you put your stop? It's like, well, you better if you had an entry in here, like for instance, if you were, whatever, trading like this impulsive move that's a fair value gap, and you got long right here at the midpoint of that. And then we went up here and you took a little bit of profit. And then what did you do? You moved your stop to break even. Then they came and got it. And then we continued, much, much higher. So those are the things that, NQ doesn't always play nice. This is an example of NQ being just a problem child. So that's more just lingo. It's not something special. It's just one of the things we say, like NQ special. She's just moody like that sometimes. Hoe bag, yeah, I could call it a hoe bag if that's helpful. Well, that's certainly how I feel
No,
about it.
I prefer NQ special
No.
to hoe bag, personally.
Oh, you prefer NQ special to hoe bag? Okay, I'll keep it
Indeed.
NQ special then. Sorry, I misread that. What's bay? What's before all else? That's what that means. Number one, she's my baby girl. Let's see. I mean, we could go on about an hour. If y'all got a little bit more time, we'll knock out a couple more of these things. I'm game if y'all are. A no tick OR, that's an easy one. On a 30-second time frame, OR is the first 30 seconds of the day. God, this chart's huge. But if we go to a 30-second chart and we look at the first 30 seconds of the day, that'll create a range for us. It's automatically drawn on my chart with these red and blue line. And so the OR 400 to 371. There's a lot of traders that trade the opening range break. It is something that I traded quite a bit the first 6 months of this year or so, and I haven't traded as much lately. It hasn't performed quite as well for me. So, but the idea would be if this is where we open, guess what? If we trade below that, and it's like the dumbest, silliest thing, we can't have a trend day up without trading back above the open. Conversely, we can't have a trend day down, a true trend day down, without trading below the open. So people typically, it comes from the pit trading days, but that first 30 seconds of activity would be kind of important for some traders throughout the day. So if, for instance, we're below the opening range, some traders are only looking to be short. And if we're above the opening range, some traders are only looking to be long. Some traders are not interested to fade back to the OR. Now, we incorporate a more dynamic approach using other elements of market structure to create other levels of big importance. But you can see, like here, this big old giant sell was either someone covering a long position or someone opening a short position, or it was some other form of hedging. But a lot of times in the past, especially, I would mark a big old trade like that. And if we, get back below where that person initiated, that tells me two things. In theory, about the nature of that participant, they're not price sensitive because they didn't turn around and buy 157 as soon as we got there. And two, that now the market is accepting and moving below where someone put a lot of risk onto the downside. So we didn't exploit that trader potentially the way we could have. I mean, we went against them, but they could just be price insensitive, meaning a large institution or a necessary order, an order that has to be made, not an order that was discretionally made. But the OR, there's a lot of ways. Like we've ran stats on the OR break. So the first 1 minute candle to close above the OR. A lot of things that you'll want to watch for if you're looking at the opening range, the opening 30-second range. If we don't trade, it's called a no tick OR. So if we don't trade 1 tick below the OR, then the idea of a trend day, the potential for that is much higher, right? That's an aggressive look from the buyers that they don't give up even a tick below the first 30 seconds. The second thing that you'd look for on a trend day like that is about 15 minutes in, you want to have, or about 5 minutes in, it's okay to base a little bit, but you want to have an excursion that's greater than like 30 points, okay? 30 or 40 points. You don't want to be 15 to 20 points above the OR, having not continued that excursion after about 10 to 15 minutes. Generally speaking, that can be a bad look. A lot of people continue to pile into the long without getting anything for it. Stops get slid up pretty close. It's a recipe for a big downside move. You also, if you're looking for true trend day characteristics, you want to be looking for VWAP. That's another one we use to look at. So we don't want much VWAP interaction on a true trend day. We want to see us barely tag VWAP and continue, or to stay above it. VWAP meaning volume weighted average price. I don't ever really look at it except for when we have a no tick. I want to see what we do with VWAP throughout that morning session. The other thing you want to watch for is after about 30 minutes, that move doesn't need to run out of juice and start giving up swing lows. So you're holding that true trend day to a really high standard. That's the way I look at it, because outside of that, it's an opportunity to fade and possibly have a really good downside move. So the truest, like most stringent standard for true trend day is no tick OR, no VWAP interaction, basing more than 30 points above the OR, and then for our work, being above a key level or two, or having opened right on a key level and see that expansive buying come in. And then no big pullbacks. You want to have that type of day where if you were selling even at the most pristine spots, those sellers still don't get a chance to get out, but for more than 10 or 15 points. You don't want to see massive big pullbacks. And then the goal of a true trend day would be to continue all the way to the last hour. A lot of times, if you get the truest form of a trend day, you get the high or low of the day in the last hour. And so if you can make it through 12, if you can make it through 10:45, so here's your checkpoints if you want to write these down. If you can make it through 10:45, if you make it through 10:45, then you want to try to hang on till 12. If you can hang on till 12, you're shooting for 130. And if you get past 130, you should be golden to hold that trade till 3 o'clock. At 3 o'clock, best advice would be to go ahead and close that joker up. You're probably up 200 points or more at that point. So if I'm looking for a trend day that's just a face ripper, those are the things I want to see. If we get to 10:30, 10:45, rolling into that 11 o'clock hour, and we start a really deep pullback, makes me real nervous based on all the other work that we do. Especially if 12 to 130, we even see a deeper pullback. You think about 3 hours of price action, an hour and a half of price action being just given back if we trade back below that. So yes, they have been the thing, dude. Look at this, you flare, you dog. We looking at the same thing. Look at this. I made this in part just for this. Equidistant moves from the OR. That's a little calculator thing to look at the extensions because of that and other things. But yeah. So
This last 5 minutes, Baba, of your spitting on the relevance of OR has for me been a highlight of this whole call. I feel like that could be like
thank
a
you.
clip. You could have that be a clip, and it's awesome.
We might just do that. Now we'll have to say, I wouldn't have all of those thoughts about the OR if it weren't for Pax, who is a trader on Twitter. If y'all don't follow him, you should. OG trader from back in the day, traded the pit, is all about not fading markets. He's seen a lot of people make money from fading, but he's never seen somebody keep it. So the idea of trading with the trend, he's a big fan of. He uses the OR and some other structural stuff to create his levels. But then also like Flary and a lot of the stuff from that we've been through with looking at the stats on all of this stuff and how the OR responds and what to expect out of a strong trend day. I mean, all of that goes back to time we spent together. I mean, 150%. But yeah, and there's no shame at all in having the OR be a critical part of someone's approach. You just have to learn the nuance of what to expect, and you hold it to that standard. Um, so if the market doesn't meet that standard, then just it's not jumping through your hoops. So what you got to guard against is then you jumping through the market's hoops. You just if you're expecting if it's a no tick OR and we're trading above the OR to the upside and we're above VWAP and we went 30 or 40 points in 5 minutes and we base a little bit and we see continuation, then you know what your standard is. You've checked all your boxes. So don't scale all of your trade off out of just and I'm speaking to me too, just out of like, well, that's going to be a lot of money. Like, let that thing work to its fullest potential, and at every turn, hold it to the high standard. It has been dog water for a little while, but then equity, yeah, exactly. It's so funny. The market just her personality changes all the time, and so we got to be mindful of that. An OR trader would have probably had a difficult time with this open, looking to be long theoretically, taking their stop if they're disciplined right back inside the OR or on the other side of the OR. You get that. Then we trade below it, retest back inside of it, no trading inside of it. You just have to learn the nuance. But then this break trades for a decent amount, but then we turn right around and basically trade that same amount back to the upside. That this would be a difficult day to be an OR only trader. So that's why we bring in some other context for it. Let's see. What do I want to do here? Easy one. The dollar. Why do we look at the dollar so much? Generally speaking, a strong dollar is a weak equities market, and vice versa. They're what is does anybody remember the actual correlation? I don't remember it, but it's very highly correlated to the opposite of one another. So you can do a correlation study. I did it before. I don't remember it, but basically you're looking for the dollar to be presenting weakness, and then that can lean you into the equities presenting strength. But they are not always opposite. They're not always counter to one another. So one of the things is say on a larger time frame, if you have a strong dollar and equities are making new all-time highs, that's something to be cautious of. Dollar up and equities up into all-time highs can kind of lead to the downside. A downside move that can be the blow off top. But typically we're just checking it to make sure that like we're not overlooking the dollar coming into some super key support, and the equities, coming into some super key resistance, or just the nature of how they've moved. A fun one for me is balance and value, and I think it's an easy one to cover. So let's do that. So balance is when. So let's do this. Well, we'll leave them both up. So no, we're not. We're gonna do it the right way. So let's hide volume by price. All right. So now we're just looking at TPO. We're just looking at the days. And actually, I'm gonna do one more thing. I'm gonna erase all non-text drawings. All right. So clean this up a little bit. And let's get a good example. This is a great example right here. So a balance area um, maybe. So we'll cover this right here for sure, and value and island. We'll hit all that. I don't know if we'll get to. We might just schedule another time and do this again and talk about micro sessions and some of that stuff. But a balance area is defined, and this is another shout out to Flary and other TPO and volume profile traders. But we're looking at a TPO chart right now. I need this to unmerge. I feel like this is all merged together over here. So I'm just going to ignore it for now. So what I like to see from a balance area is the value, which would be delineated or differentiated from the rest by the gray. So this is the value. This is where we spent 70% of our time. It overlaps to the right with this value. So if I drew a rectangle here, value overlapping value. So although the market moved from a low to a high, value is overlapping. So this is starting to look like balance. Then this day builds its value here. And what do you know? It overlaps as well. So now we have value that overlaps. Oh my God. That overlaps value. That overlaps value. So then when we have that for 3 days, and this chart's actually grouping 2 days, but when we have that for 3 days, the high and the low becomes a balance area. So this actually needs to be like there. But for the sake of this, you box those the entire situation, high to low, and you say this is a balanced price range, meaning value, overlap, value, overlap, value. So if we leave this area, a move to the downside is likely because everyone that needed to do business in here has theoretically had the opportunity to do that because all of the time spent overlapped in here. Nobody wanted to go up here and do all that time. Nobody wanted to go down here and do all that time. We did it all right here, and then we settled out. So a balance area then creates with it some rules to trade by. And the rules to trade a balance area are a re-entry into balance area low creates a look to trade from balance area low to balance area high. So when we re-enter this area, it's a little trickier because we had a little gap action. But let's go look at an example of a balance area that we. Okay, so here's an example. So here's a balance area. We tried to trade out the top. We sucked back in, and we traded all the way back through it. So we don't look for tons of support. The only thing we look for is where the value overlaps to be a possible place. So either value area high or value area low being responsive to keep the waterfall from happening. Outside that, we expect it just to roll all the way through, challenge the low. If we peak below it and then close back inside it, that can be bullish to then start the journey back to the other side. So there's some balance area rules that go along with it. But if you look over here, when we came back into it, we tested back into it. We only made it about halfway through. We pull off a little bit, and then when we get back through it, she's gone. Off to the races, leaving this all behind. And so now we're coming back to this RTH gap and that old balance area high, possibly at some point. So balance areas are the high and low of days with overlapping value. A value area is I'm gonna be looking at the same exact thing, but I'm gonna be looking at the volume for and I'm going to use the volume. So we'll do this. I'm going to do the same thing, but I'm going to look at the volume and how it is overlapping or not. And so a value area overlapping, so that encompasses this, and then this is all inside of this. So this is a value area. This value area is the same as this balance area. And value area rules are, if we trade back inside a value, we want to rotate to point of control or midpoint roughly, and then we want to rotate to the high. So it can give you some larger trade theses, I don't know, going into a day. There's other balance areas where the value area is not the same as the entire balance. For example, this one. So the balance area is 16,505 to 17,043, but the value area would only be this. This would be value, which we tested down towards the bottom section of, and then continued up. So failure, if we were rotating back through, failure for the bears to get below 606.75 is a real fumble, because they're rotating through this value, trying to rotate through it. So we would look for, let's say we were traded up here, traded back in. Say we traded below the value, the orange box, but we stayed inside a balance, and then we recovered value. This would be a recipe for a rocket ship. Especially if, this was the swing high and we got back above that, right? Or whatever. But I think does that kind of make sense?
Yes.
So
Thank you so much.
yeah, value is off of volume. Balance areas are off of like the high and low of daily candles when the value area from a TPO perspective overlaps. So there's two different things, and it's just, honestly, it's all just a way to organize information and make it more actionable. So you organize it in certain ways, and then it eliminates a variable, and then when the variable is eliminated, you can then create a rule set and then test the efficacy of the rule set, because you've eliminated the variable of how am I going to organize all of this. I'm going to organize this information this way so that every time I look at it, I'm thinking and trying to ascertain the same ideas. It's very similar to how we're organizing, these sessions in 6-hour chunks. Because it's just another way to organize viewing the information, or the same way that we're organizing, even down to these smaller sessions. I'm trying to get it. It is just the way all of trading, in one sense, is just how can you organize the information to eliminate your wild hair trades, which is when you're just innovating and just, I'm just going to do whatever. We're going up, I'm going to buy. We're going down, I'm going to sell. Not the worst idea, but it could be quantified, qualified, structured a little bit better. So here's what I think. I think if anybody's got any questions, thoughts, wants to chat or whatever, we'll do that. And then we'll save some of the other questions on the list for another one of these. We'll do it again, and we'll record it.